Hey, welcome back to the What the Wealthy Do podcast, where we break down the money moves that the wealthy or sophisticated investors make and show you how to apply those same strategies on your own personal wealth building journey. I am your host, Stephanie Dorsey. I am the CEO and co-founder of Margins Capital, an investment firm focused on providing women and people of color access to an institutional quality portfolio of alternative investments. So this is part 3 of our bond series. This is the final part, the final piece. In part 1, we talked about what bonds were and why you should never ignore them. Part 2, we talked about interest rates, the Fed, and yield curves. Today, we are building the actual strategy. How much do you allocate? Which bonds to choose? When to buy them? And how to actually get started with even a very small portfolio. And a quick reminder, this podcast provides financial education and not financial advice. So let's get into it. So, the main question is how much should you allocate towards bonds? And this is a question that everyone asks. And the answer really just depends. It depends. We love that. But it depends on 3 things. And that's your age, your risk tolerance, and your financial goals. The old school rule was you invest your age in bonds. So if you're 40, you put 40% of your investments in bonds. But this is much too conservative now, right? People are living longer. Bonds underperform stocks over the long term in a very material way. And so the rule evolved to 120 minus your age in stocks. So here's the thing. The wealthy or sophisticated investors don't use a one-size-fits-all formula. They allocate based on where they are in life and what's happening in the market, and frankly, what their goals are, which is probably just to make as much money as possible. So if you're building wealth in your 20s through your 40s, you can afford more risk. And actually, if you're building wealth into your 50s and 60s, you can afford more risk today than you could 30 years ago, I believe. If you're preserving wealth in your 60s and beyond, then bonds need to become more of a fundamental part or a foundational part of your investment portfolio. And market conditions matter too. When interest rates are higher, bond prices are lower, and that means you can buy previously issued bonds today on a discount and you're going to get a more attractive yield. And this is when sophisticated investors start to shift into the market when interest rates are higher. When interest rates are lower, they start to shift out because you remember lower interest rates mean higher prices, meaning yields are going to be smaller because the prices are higher and there's not as much value for you to derive based on when that bond was previously issued. So the key takeaway is that bond allocation is dynamic and not static. It evolves with your life stage, your financial goals, and how the market is performing. So let's talk about life stage. And here's a simple framework by age. So if you are mid-20s to mid-40s, you should be thinking about being as aggressive as your risk tolerance allows you to be from a retirement perspective. And so your bond allocation should be somewhere between 5 and let's say 15, 20% for the really, really risk-averse folks. Bonds are basically your safety net while stocks do the heavy lifting. If you are mid-40s through to your mid-50s or even early 60s, then you're earning more, you got responsibilities, you want some protection if the market crashes, right? So your bond allocation should look a little bit more like 20-ish%, right? 20 to 30 if you are a very risk-averse person. And then you want to think about adding intermediate term bonds, as well as if you're in a higher tax bracket, you would consider looking at municipal bonds if that's your jam. A major crash now could absolutely throw a huge wrench into how you fund your retirement, right? So you really need to be thinking about adding more bonds to your retirement portfolio so that you are covered in the event that there is a market crash before you retire or even during retirement. And so your bond allocation should be higher, like 40, 50, 60%, depending on your age. You should be thinking about how to use bond ladder, and we'll talk about that in this podcast to make sure that you have the income that you need to help fund your retirement. You also can be thinking about when you're 60 plus holding treasury inflation protection securities or those inflation protection bonds, as well as I bonds, just to make sure that the dollar that you put in today, even though inflation is going to to be eroding the value of that dollar, that you are protected so that you can continue to maintain your lifestyle based on how much money you have. All right, so which bonds should you buy? All bonds are not created equal, and the sophisticated bond investor choose which bonds to invest in based on specific goals. And so here's the rundown. You have U.S. Treasury bonds. They have zero default risk. The interest is exempt from state and local taxes. T-bills are 1 year or less. They're great for parking your cash. T-notes are 2 to 10 years, and T-bonds are 20 to 30 years. They have higher yields, but more interest rate risk, right? If you're talking about 20 to 30 years out. TIPS, or Treasury Inflation Protected Securities, adjust with inflation. So when inflation rises, so does your principal and interest. Use them as 10 to 20% of your bond allocation as an inflation hedge. You also have I bonds, or Series I savings bonds, and you buy them directly from the Treasury. The minimum is $25. The maximum is $10,000 per person per year. And these are great for really conservative savers, especially when inflation is high. So interest is tax deferred, and if used for education, it may even be tax free. Municipal bonds are for high earners. Interest is tax-free for the federal level and often state level if you buy in state. So a quick example, muni, that's what they're called, paying 3.5% tax free is equivalent to a taxable bond paying 5.5% if you're in the 37% tax bracket. So if you're in the 24% federal bracket or higher, munis should be on your radar. They really should. Corporate bonds pay higher yields than treasuries, but you should really think about sticking to investment grade companies like Apple, Microsoft, Johnson & Johnson. You want to leave the high yield junk bonds to the speculators. Frankly, the sophisticated bond investors that are doing this as their job. The wealthy take their risks in stocks, but not in bonds, right? Bonds are there to add diversification and offset any risks or volatility that happens in the stock market. Lastly, bond ETFs are a pool of different corporate, treasury, and or municipal bonds that you can get access to. And so these ETFs are good investment options if you have less than $50,000 to invest in bonds. The pros are you get instant diversification, there are low minimums and professional management, and they're also easy to sell and buy. The cons, though, are you don't really control individual bonds. There's no specific maturity date, as well as there are some small management fees associated with them, 0.03% to 0.1%. And frankly, this, though, is a really good option. And most people who are investing in bonds are investing in ETFs. And so it's all good. All right. I alluded to this earlier when we were talking about bond ladders, and this is a strategy that you all should know. And frankly, you can take the same strategy and use it for CD ladders, or it's for CDs. So a bond ladder is when you buy bonds with staggered maturity dates, so that some bonds mature every year or every few years. And so here's an example. You have $100,000 to invest. Instead of buying one 10-year bond at $100,000, you split it with $20,000 in a 1-year bond, $20,000 in a 3-year bond, $20,000 in a 5-year bond, $20,000 in a 7-year bond, and $20,000 in a 10-year bond. So why do we like bond ladders? Because one, it reduces interest rates. Let me refresh your memory to an example from the last couple of episodes. Say you want to buy a bond that Apple issues. It's a bond that has a maturity date of 5 years. It pays a 5% coupon rate, and you put $10,000 in it. That means you're going to get $500 a year for 5 years, and then you'll get the full $10,000 back at the end of the 5 years. If you put all $100,000 into that bond, so you buy essentially 10 bonds at $10,000 a piece, or you put the whole $100,000 in. If the interest rate shifts down, then yay, great. Your value is awesome. If the interest rate shifts up, then the value of your bond loses value and you're stuck in it until the 5-year maturity happens. You earn good money, real good money, and yet you're still not entirely sure how to manage it and invest it. You've listened to the podcast, you've attended the webinars, and you've already started investing. And somehow with all of that, you're still second guessing and afraid that you won't be able to create that 7 or 8 figure wealthy life of your dreams. The Sovereign Collective was built just for you. A judgment-free and safe space specifically for high-earning Black women who are ready to stop pretending that they have it all together and actually start building generational wealth. Just 20 seats. 20. Learn more at joinsovereign.co. And remember, you are always wealthy. So if you are thinking long term, though, think about, let's zoom out, and you are a 65-year-old healthy person that's likely going to live to your 85. You have $100,000. You don't want to put all $100,000 into one bond. And so you would do a bond ladder, and you would put it into different bonds over the course of the 20 years or whatever that you want to invest, so that you can have a little bit more control over when the funds get paid out, as well as how to reinvest. So after 5 years, now let's say you're 70, you get your money back from that one Apple bond investment, and then you get to reinvest it. So if you did a bond ladder, like I mentioned before, where you did $20,000 in 1 year, $20,000 in 3 years, $20,000 in 5 years, $20,000 in 7 years. So when that 1 year bond matures, then you get to look and see what are the interest rates, and you get to decide where to reinvest that $20,000 based on what is happening in the market. And so that is another reason why you want to do a bond laddering system instead of putting all your eggs in one basket. Also, it's great for regular cash flow, right? So every year or two, a bond matures and you get your entire principal back. And then you can determine whether or not you want to live off of that or you want to invest it in something else. Sophisticated investors use bond ladders in retirement to create predictable income without having to sell stocks during a downturn. You can build one with individual treasury bonds or with bond ETFs focused on different maturities. So it's just great for you to have more control. The more control and flexibility, the better. So when do you buy bonds? Timing actually does matter. So here's when to lean in and when to lean out. So you want to increase your bonds when interest rates are high. Lock in those yields before they drop. So in 2023, a 10-year treasury was paying over 5% and sophisticated investors loaded up. So you want to increase bonds when stocks look overvalued and when the yield curve inverts and signals a recession, and when you're approaching a financial goal in the next 3 to 5 years. And so you want to decrease your bond exposure when rates are near zero. Remember 2020, 2021, when treasury yields were under 1%. It's like the wealthy reduced their bond exposure and they bought stocks and other alternatives. So you want to decrease bonds after a market crash when stocks are on sale. And when you're young, with time on your side, and when inflation is rising fast, in that case, shift towards TIPS, I bonds, or alternative investments or real assets. So if you don't have $100,000 to start, here are your options for buying bonds. One, you can buy a bond ETF. We talked about that. It's the easiest way for most people, and it provides diversified exposure. ETFs have low minimums. Each share costs like $70 to $100, and they have very, very, very small management fees. So if you have less than $50,000 to invest in bonds, this is the move. Feel good about it. Option 2, you can buy directly from treasurydirect.gov. And this is how you buy I bonds and TIPS straight from the U.S. Treasury. The minimum is $25 for I bonds. Great for anyone who needs inflation protection and guaranteed safety. The third option is you can buy individual bonds straight through your brokerage. Fidelity, Schwab, Vanguard, any brokerage, E-Trade that you use, they all let you buy individual treasuries, corporates, and municipal bonds or munis, often with $1,000 minimums. And so this is how you build a real bond ladder. And this is best for investors who have $50,000 or more to invest in bonds. And option 4, you can do target date funds. So you can set it and forget it. You're going to see these all through your 401ks. And this fund automatically adjusts your stock and bond mix as you age. So you don't have as much control. It is completely hands off, but you don't have to worry about whether or not to remember to adjust and to mark the market and see what's going on to manually make these adjustments yourself. So some common mistakes to avoid is to ignore bonds entirely. Young investors should still have some bonds in their portfolio. It's a balance. You don't want to over allocate to bonds when you're young. You don't want to be too conservative, but I tell everyone, to thine own self be true. So you want to make these decisions based on just complete authentic alignment for yourself. Another mistake is chasing yield without considering the risk. Junk bonds will pay you more, but they absolutely can default. Another mistake, don't buy 30-year bonds when the Fed is raising rates. Stick to short and intermediate maturities so you can reinvest as rates climb. Don't forget about inflation. If your bonds pay 3% and inflation is 5%, you're losing purchasing power. So hold TIPS or I bonds as a hedge. And don't forget to rebalance your portfolio. Your allocation drifts over time. Check it every year. So here's what I want you to take from this entire bond series. Bonds are not optional. They give you stability when stocks crash, predictable income in retirement, inflation protection if you choose the right ones, and tax advantages if you use munis. Your allocation should evolve as you age. Light when you're young, heavier as you approach retirement. And you want to choose which bonds to invest in based on your goals. Treasuries for safety, TIPS and I bonds for inflation, munis for tax efficiency, investment grade corporates for income. And most people should use bond ETFs. They're simple, diversified, accessible, inexpensive. And if you got more capital, don't forget a bond ladder is your friend. Bonds are not necessarily sexy, and they might not be exciting, but they're the foundation of a wealthy, balanced, resilient portfolio. Okay. All right, y'all. That is it. And that is the conclusion of our entire bond series. If this changed how you think about bonds, share it with a friend. Follow the show and drop us a 5-star review so more women and people of color can get in on these wealth conversations. And if you're at a place where you're like, okay, girl, I got all this information and I still don't know where to get started, you should look into joining me and some amazing women in the Sovereign Collective, where we are collectively working together to support each other on our own independent wealth journeys. You can look us up at joinsovereign.co, where we are holding each other accountable and supporting each other as we build the investment portfolios of our dreams. So that is all. Don't forget to like, follow, share, and subscribe wherever you get your podcasts, on Apple, Spotify, or YouTube. And I will see you next week. Bye.